Investing is basically putting your money to work, but your investment decisions, returns, risks, even the rules of the game often depend on government policy. And Union Budget 2025 brought a set of changes that investors had to adjust to. So as we head towards Budget 2026, here is a quick recap of what changed for investors last year and how it played out. Budget 2025 wasn't just about tax tweaks. It signaled a broader policy direction, more money in people's hands, simpler rules, and a more level playing field between different categories of investors. For retail investors, that meant higher disposable income. For institutions, it suggested a more stable and predictable investment climate. The biggest push came from personal tax cuts. Under the new tax regime, individuals earning up to 12 lakh rupees paid no tax. For salaried employees, the figure was 12.75 lakh rupees. So the result was simple: more investable surplus in the hands of millions of middle-income households. And what followed was hard to miss. Monthly SIP inflows in mutual funds touched record highs. Demat accounts crossed 150 million. And retail investors stayed net buyers even during periods when foreign capital pulled back. One of the most discussed changes was in capital gains taxation. Long-term capital gains on listed equities rose to 12.5% from 10%. Short-term gains went up from 15% to 20%. Foreign portfolio investors were brought under the same long-term capital gains slab as domestic investors. Yes, that reduced net returns at the margin, but the markets digested it faster than many expected. A big reason was that the new regime was simpler, more consistent, and reduced room for arbitrage between investor classes. In other words, fewer surprises and clearer rules. But there was one major letdown for investors looking beyond equity. Indexation benefits for debt mutual funds were not restored. That meant long-term gains from debt funds continued to be taxed at slab rates. For high-income investors, this made debt funds less attractive than they used to be. The mutual fund industry called it unfair. The government didn't budge. Some investor categories saw quieter indirect benefits. Real estate investors got a boost when the interest deduction on home loans was raised to 3 lakh rupees. That translated into higher post-tax savings for home buyers and a potential support for housing demand. Gold investors got policy stability. Import duties weren't hiked, and new tariff clarity reduced uncertainty. But sovereign gold bonds were not issued in FY26, nudging investors more towards ETFs. Insurance also saw notable changes. The FDI limit was raised to 100% and new rules widened the definition of health cover. For institutions, this opened the door to more capital. For consumers, it raised expectations of broader coverage and better products. Now, beyond taxes, Budget 2025 also pushed reforms aimed at making investment and doing business easier. Over 100 economic offences were decriminalized, KYC norms and investor onboarding were simplified, and SEBI capped mutual fund charges, making mutual funds cheaper for investors. There were no corporate tax cuts, no dramatic announcements. Instead, the approach was incremental. Quiet reforms delivered steadily. Union Budget 2025 didn't rewrite the investing rulebook, but it realigned it. It shifted the focus from exemptions to income, from complexity to clarity, and from dependence on foreign flows to stronger domestic participation. In the next episode, we'll look at whether last year's budget actually boosted capital expenditure. Follow Business Standard for more budget-related explainers.